Okay, welcome everyone to today's first event, which will be centered around the challenges and threats of redefining Europe as a financial center. I'm very happy to introduce our speakers: Alexander Dibelius, Managing Partner at CVC Capital in Germany; Ludovic Subran, Chief Economist at Allianz; Andreas Fendel, Founding Partner at Quadriga Capital; and our Chair and Moderator, Bobby Vedral, Partner at Macro Eagle. And with these very short introductory words, I will now hand over to you, Mr. Vedral.
Thank you very much, and welcome everybody to today's session. As an LSE alumni myself, very impressed always by what the students of the LSE managed to put together in this German symposium, and congratulations for the 20th year. We are, unlike the previous events I've seen this week, we will not have introductory statements. We will go straight to questions. And so, I can only encourage you guys to put your questions on the chat, keep them short, make them a question, not a statement. And that makes it also easier for others to read and upvote accordingly. And that will in turn make it easier for me to pick you and ask the questions to our specialist. Quick introduction. I think finance is incredibly exciting at the moment. There's so many changes going on, purely from a geopolitical perspective. We have the rise of China, but over the last 40, 50 years, we have had a very dollar-centric financial system. Will that change? We have Brexit, which effectively makes big disruptions in Europe, in the financial ecosystem, by detaching, London and Edinburgh, two of the leading centers, from the rest. We have obviously very important socio-political changes going on pre-pandemic already. We see, how last year the Business Roundtable in the US said that, stakeholder value is now more important than shareholder value. We have the whole rise of ESG and central banks now even taking a responsibility for it. We obviously also have pre-pandemic the whole notion of QE and zero interest rate, and the whole thoughts of Japanification that could bring with it. Then, apart from these geopolitical and socioeconomic changes, we have an incredible amount of technology disruption going on, blockchain, digital payments, obviously also the bad part, cyber threats. We have incredible changes in the market structure going on, rise of passive. Now, obviously, we saw last week now the rise of activists, even from the retail front. And then, we have COVID, which clearly has established MMT now. So, seems like we can issue debt forever and for free. We obviously have also big changes to the way we work, with most bankers, as you can see, probably working from home and quite successfully, actually. So huge amount to discuss. I encourage you really to put your questions, but I will start maybe each one in turn. I start, maybe let's do Andreas first, then Ludovic, then Alex, about really the question of how do you think the financial ecosystem in Europe will change over the coming years? Obviously the center, because of this event, mainly being Germany and UK, but really in general. And if I may say, if I look at the global financial center index, you clearly have New York's #1, London's #2, but then you have like the next 5, 6 are all Asian. So Hong Kong, Singapore, even Shanghai, Tokyo, and only then comes Europe. And by the way, it's the Swiss first with Zurich and Geneva, and only then comes Frankfurt, Luxembourg, Amsterdam, Paris. So would really be interested in how you guys think this will evolve in the years ahead. Andreas, you want to start?
Yes, please. First of all, I would like to say hello to everybody. Great that to be here and to talk to such distinguished audiences and the leaders of tomorrow. Thank you very much. I would like to deal with your question from a sort of private equity market point of view. And let me shortly give you an overview about some characteristics of this market in order to understand how the capital streams are allocated and where they are coming from. And let's have a look before all these disruptions started in 2015. The amount of private equity funds raised in Europe in 2015 was about 54.7 billion euro. Thereof, the UK held a share of about 44.6%, while the DACH countries held about 6.2%. Just as a matter of information, the France and Benelux countries held about a 26.5%. So UK, France, Benelux, DACH. This volume increased in 2019 to 109 billion euro, or in other words, it doubled. And interesting wise, the UK share has increased in this time, despite of Brexit, to 55.9%, while the Dutch share increased to 7.3%, and France and Benelux decreased from 25.8%. Or in other words, this shows that the Brexit has not had a real impact on the capital formation in the UK versus or in comparison to its peers. But interesting wise, if we look at another statistic, what happened with the capital, we are seeing that the UK saw equity investments into private transactions in the amount of about 10.7 billion in 2015, and the German share has been 5.9 billion, or in other words, 55% of the UK volume. And in 2019, the equity investments in Germany increased to 14.2 billion, which represents a similar volume as the UK in the amount of 14.4 billion. So almost an equalization, or in other words, the capital was, so to say, formed in the UK and invested in the rest of Europe, mainly invested into the rest of Europe, i.e. Germany and the other countries. So this, so to say, trend is underlined by several surveys. So why the UK still stays attractive for funds being raised. 60% of the participants in these surveys positioned the UK less attractive from a sort of investment point of view. So there has been a change in terms of attractiveness of the markets to be invested. And Germany is perceived the most attractive country for investments in the EU, followed by Sweden and the Netherlands. So coming back to your question, what this shows is that on one side, the ecosystem in the UK is still ahead in terms of attracting capital, while the fundamental markets or the corporate markets are shifting towards Europe.
Thank you. Ludwig?
Thanks, Bobby. I think, I have three introductory messages. The first one is the next 2 years are all going to be about the beauty contest between European capitals to get the crumbs from the city. And that's why you see this lobbying, this reputational risk coming back to the center stage all across Europe, of course, in Germany. At the same time that the government launched Germany Finance, the scandals of BaFin were unraveling. In France, everything is banked on ESG. In Amsterdam, in Dublin, everything is about taxes. So you see basically that what has happened since 2016 onwards, which is exports of financial services between countries in Europe increasing. France or Netherlands have increased their exports of financial services by 40% from 2016 to 2019. This is going to continue till we have a big leveler, which is the Capital Markets Union. And I think we need just to see what we want as a model. Do we want a cannibalistic model, or do we want a cooperative model? And this is going to be, I think, the bulk of the decision we're going to have to make in the next couple of years, because the equivalence for financial products is going to be by product. The European Commission was very strong about this. And to get, whatever the UK has to let go, the UK is 20% of the global markets, 70% of all funds raised, more than 50% of the interest rate derivative, more than 80% of the euro-denominated clearing. It's a massive critical mass of financial products. And we're trying to get a little bit of everything. But what made the success of the city of the 50s was tax. And so I'm looking into what are, Frankfurt, Amsterdam, Paris, Dublin, Milan, what are they going to do to get the crumbs of the city? And is the response only to lower tax for repatriates. That's my first point. The second point is, when we think about the CMU, so when we think about the great leveler, where we could actually be harmonizing even more in Europe, are we sure we want to do that when it comes to insolvency? Are we sure that we yet again be competitive when it comes to lowering costs for cross-border investment, especially on withholding tax? So here again, you see that after the 2 years of chaos, where we're all going to try to get something, when we have the CMU, it's all going to be about, what do we do with insolvency law, which is a big issue across countries? What do we do with standards and regulation? And what do we do again with taxes? And the third point is can ESG change the game? Because everybody says, oh, maybe the way Europe can be attractive is through an ESG factor, but the UK is doing the same. So I think we're going to have some time to discuss this from a macro perspective. Of course, ESG could be a game changer for Europe as a global financial attractive marketplace, right? The problem is here again, that if I just listed before the meeting the type of financial disclosure firms have to do when it comes to ESG. You have NFRD, taxonomy, EIOPA, TCFD, NFGS at BaFin. This is a nightmare. So how do you want to be attractive? How do you want to be the Singapore, of Europe, if you have this chaotic, non-transparent way of pushing companies to do financial disclosure? So, that's for me is going to be the three challenges of the next couple of years when it comes to financial attractiveness, if we want to be serious in that game, or it's all going to move east and very fast.
Thank you very much, Ludwig. Alex?
Yeah, from my perspective, a lot has been said. I just want to kind of try to get a more global perspective. One, I think what we are never going to change is that the most attractive markets are the most liquid markets. The most liquid markets are the markets where there's the big pools of capital, and that's going to be the US. So from that perspective, all we are going to see with regard to ESG movements and this and that and pressure from investors is all coming from the US. So it was always a sort of, from my perspective as well, a fallacy to think that we in Europe would have the chance to kind of define rules for the global capital markets. This is worsened now by the fact that the liquidity that we had within the European Union, with London as a financial center, that this is now even more dispersed. So from that perspective, influencing and creating liquidity on markets and the right with that to kind of influence the markets themselves has gone down. And now there is a somewhat strange fight going on between the local European markets. And at the end of the day, again, liquidity on markets counts. And that is kind of now divided between different markets, and it will make the markets less attractive overall, and they will not be able to compete against the US. For ourselves, if you look at our last big fund, 22 billion, more than 22 billion, the majority is coming from the US. And despite we are a quote unquote European incorporated fund, still the big money flows are coming from the US and from Asia. So that's one. Second, what we shouldn't underestimate is the actual difficulties in working in the financial markets. If I see now, if I'm sitting in Germany, a banker located in the UK can't call me anymore and make me a suggestion or show me a new idea. Before he has to call his colleague sitting in Frankfurt, has to have him as a chaperone on the phone, and then they jointly kind of propose an idea or a product or whatever. That makes the markets less attractive, more complicated, and more costly. And so from that perspective, we all hope for Capital Markets Union, but until this comes, it's going to be very, very difficult. So overall, I think what Europe as a total has done itself a disservice with the Brexit, regardless if it is now UK originated or European Union originated, and when we were to kind of try to build London as a financial European hub. This chance is now gone, and we will lose out as Europe more to Asia and to the US. That's basically my observation.
Thank you for that. A quick question, taking on this, and a little bit what also Ludo said when he said London rose as a financial center in the 50s because of tax. I think the other reason, though, London rose as a financial center was because it positioned itself smartly as the place of intermediation. So if you think correctly what Alex said, the US is the source of capital where the liquidity is, but London positioned itself as an open ecosystem in order to intermediate. Back then, obviously, the Russian money and Soviet money, etc. And the question here is, to the point of what Alex just said, that what we have seen, there's no financial agreement for financial services in the current UK-EU agreement, that it feels a bit that Europe shuts itself up. And obviously, if you think about it, like in the UK, as Ludo, I think, said, 50% of the currencies of dollars are traded there, 80% of US interest rates are traded there. It doesn't hurt the strength of the dollar and the power of the currency at all to be so open and letting London have that role. Do you guys have a view on, is Europe overall, as Alex just said, doing itself a disservice by being so harsh at the moment on the implementation of the rules? Or is that just, an important step to take because Europe needs to become, financially autonomous, let's say? I don't know if you guys have a view. Alex, you want to start this?
I think it is on one side, on the global perspective, it definitely does itself a disservice. Obviously, in the bilateral issues between the UK and the rest of the European Union, where the European Union must make clear that politically it is not possible just to have the common markets or the common financial markets without adhering to the different standards. That's why politically this fight will go on, despite from a market efficiency and perspective, it would be clear that we all would take advantage if we would kind of quickly come to a sort of back to the sort of passporting regulations that we had in the past. But politically, that is not feasible, because otherwise the rest of the European Union nations would say, the UK could get away with it. So why shouldn't I kind of just pick and choose what I want to have from the Chinese menu? But that politically is not feasible for the European Union. So that's a bit the crux, and probably as much as a more liquid, larger market would help us in the global context. Politically, I think it's not something that will kind of see to happen in the short term.
Thank you, Ludo.
I think you ask two questions in your question. The first one is, are we doing ourselves a disservice by being so harsh on the UK? Somehow, yes, but because we didn't do the right things. I think the Commissioner for Financial Services has been very silent. So we haven't really prepared for Brexit in the way we should have prepared for Brexit, including on advancing the capital market union. That was a cornerstone of this being less of an issue should the UK leave. So to a certain extent, it is now a source of friction and chaperones. And Alex mentioned the fact that it's going to be quite messy for quite some time. But to a certain extent, I still believe we can do things. You mentioned, for example, the internationalization of the euro. We are very bad with that. When I look at what China has achieved with the renminbi over the past 5 years by putting renminbi paying facility everywhere, we don't really know how internationalized we want the euro to be. So it's a series of things that we should be doing. But, and this goes to your second point, I think the issue is, we did not think of Europe as an intermediation marketplace. When it comes to regulation, we let basically national regulators and supervisors rule the game. And it is a nightmare because, you know, you have so many dislocations, if you will, between countries, and so little, you know, you have a lot of perverse effects. We see that, for example, with Solvency II in the insurance world. And you have somehow this idea that, you know, the financial sector should just shut up. You know, the banking sector is completely administered under COVID-19 response. You know, for banks across Europe, the big question is how much the ECB is allowing them to lend. So there is, you know, and when you look at the market capitalization of the banking sector in Europe, it's very sad compared to the banks in the UK or the banks in the US. They're much better than in 2008, 2009 because their capital ratio are better. But to a certain extent, you know, the entire banking system is a bit pseudo-nationalized. In the other financial segments, you know, I guess there is the idea that we should be a bit quiet and not voice ourselves a bit too much about the sometimes bizarre set of rules against which we have to operate, because, you know, the financial sector has, you know, dragged a bit of a, you know, image that we have benefited a lot over the past 10 years. And so we shouldn't really say, you know, how we want, for example, Brexit to be managed. And I think this is a big mistake because finance is part of the solution, including, you know, for Europe to grow, you know, digital, green, manufacturing, all of the things that you see in next generation. You need a strong financial sector to do that. You don't need a weak financial sector to do that. The problems, I think, you know, the rest of the issues have been, look at how much we talked about fishermen during Brexit. Do you know how much fisheries represent compared to the financial sector in GDP points for both areas, for the UK and Europe? Finance has decided to go, you know, through the back door because they're a bit ashamed of themselves. I think that's inherited from the past crisis. And as a result, now we have a bit of a bizarre solutions because we're going to have to be nice to the UK on the financial sector, or it's going to be much more costly to the final user. These friction costs are going to be passed down on the final user. And this is going to be problematic, I think, in terms of how M&A deals are going to be run, how, you know, the products are going to be available, how costly are they going to be, and something that was not prepared enough. And I still think we have a window of opportunity to do it better, but I don't see it as being on the you know, I see these issues, unfortunately, on the back burner because of COVID, and everything is about the COVID response and not about the foundations of what we want Europe to be in 5 years from now. We have this difficulty to be a bit forward looking in these times, and this is a bit of a pity for the financial sector.
Perfect. Andreas, I will not have you, you know, repeat. I think there were already quite extensive answers here, unless you want to add something. But what I would like to add, you given your expertise on, you know, in mid-cap. There's a question from Maximilian Stoiber, I think LSE. If you could raise an investment fund focused on achieving outsized returns in Europe over the next 10 to 15 years, what would be the focus of such a fund? Public versus private, small versus mid-cap, or large? Which sectors? Where do you see the most attractive opportunities in Europe at the moment?
Thank you very much. A very good and interesting question, because indeed we are in mid of a transformation of many areas of our ecosystem. We just spoke about the political landscape. You mentioned in your introduction digital disruption, etc., etc. So transformation, disruption, changes, basically great times for private equity, because private equity can play a very important role in these transformation processes. So we see in our mid-cap segments a lot of companies which are ready to be sold because of these transformation challenges, which are triggering, let's say, threats to the existing owners, to the CEO, founders, etc., etc. So therefore, it is no surprise that the deal flow has increased in all segments, in large cap, mid caps, and small caps. We see on the corporate level a lot of changes, carve-outs, spin-offs, or divestments of larger corporations are driving the deal sizes. If you look at the returns, you can see that from a sort of MOIC, or in other words, money multiple on invested capital, IRR, that the smaller and the mid-cap segments are generating higher returns in the average and on a sort of compounded basis than the large cap sector, while the large cap sector has the advantage to be more liquid and to use more exit channels to capitalize the investments. It is no surprise that many PE companies have understood that they have to offer much more than capital to the investee companies. And that is also driven by more focused investment approaches, or in other words, sector-driven investment policies. And what we see is that there is a lot of capital which is being invested into the healthcare sector. We see a lot of capital which is being invested into technology-based service companies / software. And we see that as we call it, smart industry sector, or in other words, the industry companies which are, let's say, more asset light than asset heavy, are becoming more and more attractive for investors. And the digitalization is, of course, driving a lot value which is expected to be generated within the next years. And the challenge will be how do you translate the digital developments like 5G, like AI, and etc. into your business models, and what can a private equity firm contribute to support the transformation of the investee companies? And that will be definitely one of the big crucial points in order to generate the value within these sectors and within these segments.
Perfect. Thank you very much. I mean, I can already see from the questions here, we're going to be jumping between geopolitics, technology, and then really investment opportunities. I think, it reflects the immenseness of what finance really covers. I'm going to go through the rankings, but I'm going to pick boys, girls. So now it's Mara Weidmann. I'm going to ask this for Alex. Mara Weidmann, student from in Mannheim, but she comes from Hamburg. Very well, I come from there as well. Question to all, which industries does Europe need to support, abandon, in order to become more attractive in the future? Alex.
Which industries
Yes,
fundamentally, I'm not a big believer in industry policy. So basically, I think at the end of the day, it needs to be market demand supply driven with regard to assets. But traditionally, I think the European industries have done reasonably well, particularly from the core land of Europe, in asset intense industries, where you had still not high tech, but mechanotronics or these kind of things. This is just medical devices, all this stuff that is a traditional strength. However, again, nothing can be taken as a granted, and I'm not a big believer that we have to go into industry policy to kind of support specific segments, but rather kind of make sure that the conditions, the boundaries, the rules are set as such that we are becoming more attractive as well for additional industrial initiatives, but that has been mentioned a couple of times by basically everybody, and everybody likes it. Less bureaucracy, easier to understand tax systems, harmonized tax systems, more liquid capital markets, and this and that. But again, and that's going back to my initial statement, in all these points, we are lacking against US markets and against Asian markets. The only thing, but that's kind of more philosophically, where we are in Europe can claim ourselves as potentially being at least partially ahead of the game, is if it comes to kind of openness of the society, and the ability to kind of fulfill yourself with regard to your wishes, and allowing people to do what they want, as compared, for example, in Asian or China, or to a certain extent as well in the US. But you can't make this a business system.
Can I just ask you a very quick follow-up on that, Alex? So if you think that in Europe we should keep, obviously focus on the right framework, but otherwise let the market decide, do you though then agree with the view that, but then Europe has to protect itself against those who use industrial policies, and hence the international level competition would be unfair?
That's probably true, but from my perspective, only short-term true. And you can easily say, yes, we need to kind of reciprocity with regard to intellectual property protection, and so on and so on. That's all clear. But the moment there is a sort of a tit for tat starting, at the end, everybody is suffering. And as some of the strength of Europe has always been that we have been trying to be open in the same way like the pre-Trump America's success has been to kind of allow people to have the American dream and fulfill your own wishes. And to the extent that we can do that as well as an economy, I think that's the strength, the diversity of Europe, and still kind of finding in this diversity a common denominator, like human rights, open economic and environmental protection, this and that, and an educated consumer. That is something that could be potentially a strength of the European Union going forward, or the Europe as a total going forward.
Thanks, Alex. Ludo, question from Joachim Raden. I unfortunately don't know from what the background is, but what are the strategic strengths the EU has versus the US, which has the dollar, and China, which has the biggest future market? Are there any at all?
First, I think in 2020, Europe decided to play in the Bundesliga of currencies, right? So I think we shouldn't be ashamed of our euro. What the ECB decided to do in 2020 is to protect the euro, whatever it costs, and it cost a lot of money to savers and to the Schwäbisch Hausfrau, that's for sure. But to a certain extent, what I think is very important is beyond what we've been doing, which is deciding for a major leap through together in 2020 to at least offset some of the exorbitant privilege of the dollar. We will continue, and Alex said it, as Europe, we cannot be functioning as a closed economy. And the choices we have to make now is whether we are the beacon of hope for some type of, free market functioning, because the US is not anymore a free market country. Just look at the platforms. Competition policy is absent on the GAFA. The US is also, Buy American is one of the first things that President Biden signed as a presidential decree when he arrived. So, and Alex mentioned that pre-Trump, the American dream was very strong, but pre-Trump, we had 8 years of Obama, when the US was the most protectionist country. We forget that the number of measures that were taken under the Obama administration, non-tariff measures to protect the US, has been record high. It was 1 in 4 measures globally, more than India, Brazil, China, right? So Europe can decide to be a counterpower to the US and China, which, on the Chinese side, we know that, I would say today, 60% of the economy is run through state-owned enterprises. Or we can decide to play the same game and try to be a bit smarter with our policy. So I would not disagree with Alex, because I think the problem is that when we speak about industrial policy in Europe, we start having all these politicians that are very excited because they can direct funds and subsidies to certain sectors, which is stupid because you don't know where it stops. You don't know how productivity will change in these sectors. But somehow we've decided, I would say, to be a bit less naive when it comes to manufacturing, health, digital, green, and this for me, I don't know if it's our biggest advantage because this is just a pledge, a promise. But somehow I have the, because we were still a big consumer market, not as big as China, not as big as the US, but we are a big consumer market because, we have this saving surplus, because we are this export machine to the world still, we have, I think, a third voice that needs to be heard. I personally have a dream that Europe is a strong counterpower to the US because we are proud of our currency, but also a strong counterpower to China because when you decide to do business in Europe, you adhere to a certain type of principles. And we can be, this place maybe for a greener, more inclusive recovery. I think the US just rejoined the Paris Accord. China is trying to be strong on greening the economy. We are far ahead. The problem is how we do it. We do it by talking about carbon taxes before we talk about carbon prices. We do it by talking about more regulation and actually a regulatory backlash in Europe, instead of trying to see how we can help the entrepreneurial states, how we can help, entrepreneurship in general in our continent, right? So I think our strength lies in our faults, if you will. We are big, we are heterogeneous, people can pick and choose where they want to be in Europe. And we have, I think, still a lot of intellectual property. We still have a lot of innovation coming from Europe, but, we are choking it, I guess, by the layering of the regulation and harmonization that we're trying to do. And this is a big issue compared to the agility of the US and compared to the drive that China has. But I don't think we should throw Europe with the baby bathwater, just yet. The question we have to ask ourselves is how can we continue to make Europe stronger as Europeans, right? Which I think we don't do enough. Americans and Chinese are much more patriot than us. And I think there are some green shoots, what we can do in research and development, what we can do on green, what we can do in services in general, the human capital side of the economy, how we can help some sectors thrive without being oligopolistic, like the platform sector in the US. I think these are good starting blocks. The question is and we see that with things as simple as the vaccine delivery. We're not as good as other economies because we pile up bureaucracies, and in these matters simplicity wins. It's the same with research and development. We need to simplify the rules, and this is something that we are not yet ready to do, and that will cost us a bit when you look at what China is doing on the innovation front these days. So I don't think we can I don't think we can be sure that Europe will be competing on an equal footing with China and the US, but we are not yet lagging behind as much as I sometimes hear, especially from the Anglo-Saxon media.
Can I do a quick, related with this question, a quick observation and question to you is, so if you look at the current, whatever GDP, US is whatever 20% of the world, Europe 15, whatever, China 15. But when it comes to currencies, like 80% are traded against the dollar still. If you look at the reserves, 60% are dollars. Europe is 20%, and the renminbi is like 2-3%. What that tells you is that, lots of people criticize the strength of the dollar, but the fact is Europe wants to be a global currency, but can't be until they fix the framework, because to this point, we really don't know who really backs Italian debt, for example. And China can be a global currency, but doesn't want to, because obviously they want to keep their markets extremely controlled and at their own pace. Otherwise, why is only 2-3% of world reserves, in renminbi? So when it comes to Europe, isn't literally the fundamental thing to increase the strength of the euro to finally solve the question of, of effectively monetary union? Fiscal union. Or do you think, look, that's just, that's politically at the moment unfeasible, and it's just we will have to, play the long ball here. But I would then say, well, how is the euro then going to become a stronger currency? And hence also, at the end of the day, you need to like the euro in order to invest in anything that is denominated in euro.
Yeah, I really think that in 2020, we did a massive leap forward for the euro. I think we decided that there would be no more risk of exiting the Eurozone, for example. I think we decided that, you know, we would do exactly like the Fed will, and we decide today, as you know, the COVID-19 crisis unfolds, to not impose ourselves too much austerity, because the US will have debt to GDP at 140% by next year. So by making those choices, we are de facto creating a risk-free yield curve at the European Commission. You know, that's the next generation EU. De facto choosing that, you know, there will be €1 and not the conceptual idea that there will be an Italian euro, a German euro. We've made those choices very strongly in 2020. Remember 2008, that led to 2012. We've gone a long way. To your question, then, we have so much more to do. And it goes to the capital market union, it goes to the banking union, all of these institutional building blocks, we understand. But beyond that, I think an agenda that has been left untouched is the internationalization of the euro. We may want to decide at one point how committed we are to have a commodity market denominated in euro. We may want to be at one point a bit more aggressive by putting euro payment facilities across the world, like the Chinese are. We will never really catch up to the dollar. The dollar is a much more ancient currency than the euro. The euro is very young in the currency world. So it's a question of time in the end, right? And about credibility of institutions and so forth. But what we could do is be a bit less naive with the use of the euro in a series of financial products. And this is where I think, because it's not in the mandate of the ECB, nobody takes the mandate at the European Commission and the heads of state, because it's Europe versus the Eurozone. That's the eternal debate, right? So the Commission cannot really advocate for what is, you know, concerning the mini Eurozone within the European Union, or that they're doing it enough. And we don't have a council of, you know, or we don't have a structure to support the euro as the currency, like the Fed and the Treasury do for the US. And this is what we need to think about if we want the euro to be considered as a much more liquid currency going forward. But we have left that agenda untouched.
Perfect, thank you. Now, Andreas, next question to you comes from Paola Bergamaschi. Guys, by the way, when you post questions, would be great to know what your background is. But anyways, Paola is asking, instead of going for a capital markets union at the EU level, would it be more effective to start with a harmonization of 2 or 3 core markets on the continent, and then use the gravitational pull to include and align the less developed and less mature ones? Maybe you can, also comment from your PE perspective on this question of, do you think let's wait for one big deal, or let's just start with core and willing countries?
Let's have a look how the reality functions for the time being. After Brexit, the Europeans tried to find a sort of new hub for asset managers, and it was decided to upscale Luxembourg. Luxembourg has an enormous inflow of capital, which is being drawn from UK-related locations. But Luxembourg is extremely, let's say, expensive. The costs are very high. Why? Because we don't have any competition within Europe after the UK has left. And if you look at the reality, we see that the willingness to create a competition in order to make the market more efficient is not visible for the time being, or in other words, the costs are very, very high and decrease the competitiveness. Now, coming back to the question, why is that the case? We know that the political let's say challenges to harmonize the market are huge. The developments, the evolutions are slow. That was mentioned already during this discussion. And therefore, I think the idea to form, let's say, an alliance, let's say, between the DACH countries, France and Benelux, for example, which are the most active markets in the PE, with the aim to further strengthen, let's say, the unification of the framework and making capital flow more efficient is definitely a very good idea and a good approach, which will help to move the countries forward, which are not yet there. Therefore, the answer is yes.
Perfect, thank you. Now, a question to Alex from Jonas Kleiber, LSE student from Karlsruhe. With private equity gaining more and more popularity in Europe, do you think it will become harder to achieve high returns in the upcoming years and decades?
Yeah, definitely yes. It's not only a European issue; it's a global issue. You know, we are living in a time where money or debt is very cheap. As you know, there are three constituent elements for private equity. One is ownership for time. Second is optimized capital structure, which is basically linked somehow always to debt. Debt is currently plenty available and very cheap. And then third is this sort of management and direct involvement and management participation, incentivation, sort of the three basic elements. Private equity has been in the past one of the only active strategies that could prove that over a longer period of time they're kind of having outsized returns as compared to normal equity returns. But with the money inflow, with the cheap debt, you know, there is obviously, and with the amount of dry money, you see a sort of a dilution of the, you will inevitably see a dilution of the returns as too much money is chasing the same deals. And that as an industry is going to be probably the future. So it's going to be difficult even on a global basis in the future to kind of make the two times money plus returns or more than 20% IRRs that you have been seen in the past.
Perfect. I'm actually going to mute myself. Maybe everybody does it because I think we have a background noise while except the one who's speaking. Ludo, for you, Elisabeth Steeman from the LSE. She writes, what can the UK learn from Germany and other continental European countries? Ability to attract funding from private sources, especially for SMEs, in particular following the COVID crisis. So basically the question being, I guess, a bit, you know, what can they, probably the European countries learn from each other? Who has been more successful or not in attracting funding for those companies that, you know, probably have less access to market? Do you have a view on that?
Yeah, you know, it's a bit early to draw the lessons from the COVID-19 crisis, but there are some fundamental differences between the choices that the UK and continental Europe as a whole did. One is, you know, partial furlough. Because the UK did partial furlough, but the generosity and the timing were a bit different in continental Europe. And so that creates a very different type of liquidity stress for the UK firms and let's say the German firms. What I mean by this is that in the UK in 2021, you should have between, you know, 25 to 30% of companies that are going to be cash constrained in a way. And it's basically because COVID was much stronger in effect on the UK, but also because the measures that were voted were maybe not as strong in GDP terms, so in amount, but also not as fast dispersed as they were in continental Europe. If I look at my own country, France, you know, we distributed tons of money to SMEs through partial furlough, state guaranteed loans, moratoria on private debt, and in the end, we had, you know, half the number of bankruptcies in the worst recession since 1945 than any normal year. Yeah. So the UK could continue to look into the measures that were taken across continental Europe, but in the end, they did. So in the end, when you look at the measures that were done towards SMEs, they did more or less the same thing. The only real question is the joblessness that would be the effect outside of this crisis. On support SME more generally, you know, what the UK has as an issue right now is the margins, the profitability cost of the joint COVID-19 and Brexit. we see a lot of importers in the UK that are in a very specific, very difficult situation because they accumulate the additional cost of Brexit, including the depreciation of the pound over the past 4 years, but also the fact that COVID creates fewer outlets, and especially some of them are assemblers that re-export. So what I would do, or what I think the British government should do, is try to identify those, to be very targeted and accompany those to bridge, whatever double friction they have between COVID and Brexit in this time, which is something that they haven't really done. When it comes to access to financing, I think when I look at credit extension, also in continental Europe, credit extension has increased massively, across the board, 20%. In the UK, credit extension by banks to SMEs has actually not increased as much. There is a reason that lies with the Bank of England compared to what the ECB has done. But there is also maybe a stronger self-discipline, because that's why I say it's a bit early to draw the lessons, because the big question is, how many zombie companies is the UK going to have after the crisis? Whereas how many zombie companies are, continental European countries are going to have after the crisis? And this is why right now it looks like the UK is not maybe doing enough, and they could do a bit more fiscal, a bit more monetary. But in the end, creative destruction could be better than, preserving creation, which is what we've chose to do in continental Europe by having a massive liquidity bridge, but also a massive support from the banks to the companies, and debt to EBITDA. So the indebtedness of companies in continental Europe has increased between 15 to 30 percentage points, depending on the sector, over the past year and a half. In the UK, we don't see this indebtedness increase on the corporate sector. We see it on the household sector. We don't see it on the corporate sector. So that's why I said, maybe it is better also to triage a bit more during the crisis with the social cost that it has, but without this, sweet poison that by the end of the crisis, some companies in Europe are going to be alive, when some companies in the UK may actually have moved capital, physical, financial, human capital to sectors that are rebounding, which is a little bit what the UK promised also after Brexit, to put a little bit more emphasis on those high productivity, high competitiveness sectors. So we could learn short term to lessen the social burden and the economic burden of COVID. But then the question is, in the DNA of the UK, agility is key, just like in the US. So the question is whether, capital reallocation would be faster in the UK than it may be in Europe, because by doing so much, we may have, created some type of stickiness that the UK will be not seeing. And so that's why the match is not done. I mean, the first set, the game is not over, right? The jury is still out on the efficacy of the measures between what the UK chose to do and Europe.
Perfect, thank you. I think the point you make about creative destruction is indeed very interesting, especially if you think about the approach the US has taken by just letting jobs go and sending them all a check. But at the same time, I'm actually following the statistics about, business startups, registrations, record high. So everybody in the US is basically creating their new businesses while they're sitting at home. Anyways, Andreas, for you, Sebastian Gab, LSE student from Frankfurt, what will be the most important developments in European private equity in the next 10 years?
Oh, if I would know that would be great. What we will see is, first of all, that the private equity industry is going to increase its attractiveness, especially in a zero interest environment. Therefore, this asset class is increasingly gaining attraction at institutional investors. Therefore, we will see a huge amount of capital inflow within the next 5-6 years, which will, of course, drive the competition. And we will see that on the portfolio side, the identification of good deal opportunities will become a very crucial and critical point. We will see that the specialization on certain topics, industrial topics, will gain relative importance, because you need deep dive knowledge of industries and companies and governance, etc., in order to understand where to create value. We will see an increasing importance of ESG and impact investments, that it will become a very sustainable long-term trend. The industry has, so to say, accelerated, in general, has accelerated its capital expenditures in these fields so enormously much that we will probably in 5-6 years not be able to sell a company which is not covering ESG and impact related management approaches to buyers. Therefore, there's a huge pressure on our industry caused by, on one side, capital, because if you look at the capital markets, impact related capital formations are exploding, or in other words, investments need to match the requirements of the capital market. And on the operational side, this needs to be reflected, and companies which are able to transform with respect to that will win, and companies which will not be able will lose. We will see a change of our value chain driven by technology. That means transaction processes will be impacted by digital developments. Transaction processes will shorten. Risk analysis processes will change because of this shortening of the processes. Also a result of the competition, or in other words, the challenges to understand the risks which are involved in a business will increase, and the companies therefore, or the PE companies therefore, need to upscale its skill base to match these requirements. We will see that the internationalization will continue to play a very important role, especially to Asia. Therefore, small and medium-sized companies, which are traditionally niche players, need to have the skill base to accelerate their presence and to be competitive against Asian peers, which are also increasing their competitiveness. That will also drive our industry. So therefore, a lot of opportunities, but on the other side, also a lot of requirements to adapt to all these developments which I just described.
Perfect, thank you. Now for Alex, this one comes from Inka Pearson, LSE student in London. She asks, the UK seemed to have left the financial service sector behind during the Brexit negotiations, and many are disappointed by the trade deal. Why do you think the UK financial sector didn't get the deal that they wanted? Let me quick rephrase this, because obviously what happened was the UK asked for financial sectors to be excluded from the negotiation, so they were never part of it. They purely focused on the trade negotiation. But I think what Inka is meaning is maybe, given that they did that, what is next? And if I may add to this, and to actually what Alex had said before, when he said, look, politically, we obviously cannot give access to Britain as if it was a member. I think that refers to the passporting. That is correct. Passporting should only be given to countries inside the Europe. But passporting refers mainly also to banking activities like deposit taking. I do think what the UK financial sector has a competitive advantage in is rather in things like derivatives clearing, investment banking advice, trading, which does not require passporting, that requires equivalence. Now, equivalence is something that you can give to any third country. So obviously, the hope is that equivalence will be given to the UK. But the key question, obviously, the reason this is not happening is because from the EU side, they say, well, equivalent also depends of if you will, if your regulation will divert too much from ours. And the problem here is, I think that the EU approach to this is to say, you will get access if our regulations align. While a little bit in the terms of what Ludo said, the British are saying, well, to be honest, the point of being out is to have a very nimble and flexible regulation that, to be honest, also, focuses more on outcomes and drops, to be honest, silly rules. So the question to Alex is, given that we have this big question hanging over financial markets of, will there be equivalence, which at the moment is obviously stupid that it doesn't exist because we effectively have the same rule. I mean, when Britain left out, we have MiFID, MiFIR, it's all in place. How, and given that we know that divergence will philosophically exist, because again, Europe will be very rules driven, while Britain will try to position itself as an innovative and responsive and dynamic regulator. Do you think that can be combined, or do you expect that to be actually quite of a tough point of negotiations over the years ahead? Alex.
Well, you stole my thunder with regard to your answer, so that's all perfectly right, and I see it the same way. Now, I see only two ways. Either there is going to be equivalence, and here and there they will cut the corners and say, yeah, fundamentally it's rules driven, but these rules are equivalent, and they will live with the sort of ability to leave the UK its kind of flexibility in these rules, because everybody and because basically intelligence prevails, because we are all better off. But it's politically hard to kind of push that through, particularly within the European Union, as you have this kind of almost moral hazard problem, because if you allow it one party, then everybody starts to kind of do whatever they want, and the whole European Union idea is slowly but surely going under. So that's one scenario, equivalence. The other scenario is the competitive scenario, which from my perspective could as well happen, by which the UK presents itself as a low tax financial hub with ease of regulation, which will attract for the time being additional money, almost like the real estate market in London in the late 2010s, or so to speak, or 2000s, was a market where there was tremendous money inflow due to its sort of quality of living, openness of the society, and this and that, and tax advantage. And that could happen again, but that in itself will then kind of call as well in Europe, the politicians cry foul, and that will then kind of move away from equivalence. But these are the two models. Which one is going to prevail? I don't know. But perhaps if we really think through that, and if we kind of live through the consequences of Brexit, perhaps the UK doesn't have any other choice than to kind of start to play the competitive game, which in order to attract additional funds and additional investment activity.
Okay, perfect. Thank you. Now for Ludo, from Isabel Scheichel from the University of Freiburg. The question is, how ambitious and also responsible is the finance market for only investing into ethical and ecological industries for sustainable future? So the big question now of, how aggressive should finance be with regards to ESG?
I think we should be much more aggressive than what we've been doing so far. We, at Allianz, we're very committed. We're one of the, we are a big convening power. We created this alliance of asset owners to commit to net zero carbon emission, to carbon neutrality by 2050. We just disclosed our targets on the asset side. We've been very active on the liability side, so on exclusion, on responsible underwriting, and so forth. I believe, you know, the world should be much more ambitious. I think the 19th century was somehow the century of equity. The 20th was the century of debt. The 21st should be about impact, and we are just starting. The big question is extra financials require so much harmonization, so much agreement on the rules. It's not as easy as a balance sheet or as an income statement. You know, we have so many. You know, we spend so much time on agreeing on what to report to avoid greenwashing. So I believe that standardization is good because it avoids this type of pitfalls. But as a result, I think we're not moving fast enough, especially in product development, in service development, in access to these products to the masses. The disintermediation that we've seen over the past decade in Europe didn't bring much of co-development of products to make sure that people have the impression that they invest in something that makes sense to them. So I believe finance, you know, is the only industry that can transform billions into trillions. So we are an essential part of whatever we want to achieve as a you know, more sustainable society and economy. But the financial sector is, you know, hidden behind you know, facade and layers and screens of complexity that makes our efforts into greening, making you know, our role a bit more impactful, I would say, in the products we support, etc., much more complicated. So we have big, you know, issues. I think the problem is the regulator wants to move faster than the machine. We've seen that with the automotive sector. It can be very costly. So I would say that the financial sector needs to get their act together to avoid a regulatory shock on stranded assets, for example. Can you imagine the cost that the regulator could impose on the financial sector should the stranded assets, so those assets were considered zero on your balance sheet because they're considered stranded, right? How much do you think it would cost to the financial industry if we have a zealous regulator right now? And Europe is full of zealous regulators. So I think it is, you know, we need to be a bit faster at reinventing ourselves. We need to move away a bit from the pure methodological debate to something that makes sense. And I've seen, you know, big inflows into ESG funds, into impact funds. So it is starting, you know, especially institutional investors, but also retail investors are interested. But I still doubt that the financial sector has taken the full measure of this in terms of reinventing itself beyond reinventing, you know, the what is visible. Reinventing the plumbing of finance is not happening yet. So you know, when you look at banking, when you look at venture capital, when you look at asset management, when you look at, you know, insurance, you know, we're really just at the beginning. So the ambition is big, but we are still stuck a bit with the methodological aspect. You know, a lot of people are believing, for example, that we spend too much time on E and the science-based target initiative and agreeing on what is really a good carbon emission trajectory and so forth. And now we need to massively rebalance toward S because COVID has revealed all these social inequalities, and we are just starting on that. You know, nobody really knows how to approach S apart from say on pay for listed companies, but that's about it. You know, so the debate is so multifaceted that I think it somehow freezes a bit the financial sector, and I think that what I can sense from America and from China is that they don't give so much bandwidth to this debate as we do. And so the big question in the short run is, by doing this Copernican revolution in Europe, are we wasting time for innovation in the financial sector that the Chinese and the Americans are going to be delivering? Or are we onto something that is much bigger than every financial marketplace in the world? And if we deliver on that, we're going to be much bigger than whatever the Chinese and the Americans are going to be able to deliver. This I don't know. That the answer will be in, you know, 5 or 10 years from now.
As a follow-up on that question, can I quick ask you, you know, as an economist, of, you know, if you look at the markets at the moment, they're clearly, you know, I would say, looking through the pandemic, and expecting a massive consumer pent-up demand to be unleashed in the summer. But the question is really so do you think that is true, and we will see this massive kind of 1920s roaring 20s kind of story happen? Or do you think actually that there is the potential for significant social political tension, because during the pandemic asset prices have risen so much and hence inequality has increased significantly? Which side would you be on if you had to take a punt?
I'm on the latter, unfortunately. I'm very concerned about the inequalities that have been exposed during COVID. The between the insider and the outsider. We had the strongest recession since the World War II, but financial assets of households have been growing 8%. So we have a 5% recession, and financial assets of households have been growing 8%. So and you mentioned some of the issues. I don't think that markets are only pumped up by future demand. There is a part of it, but markets determinants are very different. They are pumped up by monetary policy. My concern is that 5 years down the road, we're going to look back in the rearview mirror and we're going to say, oh, did the central banks save financial markets instead of saving the real economy? That's my big concern, and I think we need to continue thinking about that when we patiently wait for central banks to do what they do as unelected powers, and the risk of rising populism, because right now, just look at who has been the big winner of the 2020. People who had savings and who were able to and ready to take risks. The others have been losing so far, and so I'm a bit concerned about us footing the bill in a disorderly way. Yes, but in the short run, if you ask me, yes, we have a recovery that is quite strong in 2021 because it's a service economy crisis. We've avoided the financial crisis, so we should have. We are actually seeing that outside of confinement period, outside of lockdown period, we have growth. Even during lockdown in Germany, retail sales in December were actually going up. So consumption is happening, and we hope that maybe a fourth of savings hoarded or accrued because of forced and precautionary savings in 2020 will be unleashed in 2021 and gives wonderful 4-5% growth. The big question is down the road, are we taking the full measure of the scarring effects of this crisis on the youth? The young people have a triple whammy. They go out of LSE in a recessive market. Their salary, when they will be 40 years old, will be 10 percentage points lower, their real wages, than the cohort that went out of LSE the year before. These people cannot access ownership of house or of property because it's too expensive. They cannot even build an equity portfolio because it's too expensive. They cannot build their pension, because if they buy Bund, it's yielding nothing. So they will have to save 3 times as much as their parents to get the same amount at retirement. These are the issues. And those are the silent generation are the millennials turned recessionals. And policymakers don't look like they're giving a damn about them. And I think this is what we may pay if we don't solve the issue now. And so I hope, we haven't talked about that, but Brexit poses a major issue on human capital formation. All of you that are LSE alumni, you went there because it was cheap. Today, if you want to apply to LSE, you're going to have to pay so much money that, if you come from a modest background, you won't be able to study at LSE as a European. This is the type of world that COVID and Brexit have revealed. And I think this is a big issue. And this is going to be costly for years, because human capital formation is the basis of every potential growth in every country. And so for me, that's where, I'm a bit, not pessimistic, but I'm a bit, worried that we're not taking the full consequences of what COVID has revealed or magnified as underlying vulnerabilities, especially on the human capital formation front.
Perfect. That was, very insightful. Now, Andreas, I'm going to read you the question. I'm going to rephrase it somewhat. This is from Orun Cicek from the University of Rostock. The reason I picked this is because, to be honest, I'm going through and a lot of, I think, the themes we have already covered of what was asked, but we haven't spoken when it comes to Europe about the periphery. So the emerging market Europe. And what Orun is asking is, isn't it time to bind countries like Turkey and Ukraine more to the EU and make them the China of Europe, where European products can be produced without Chinese control? This would reduce industrial espionage, One second, somebody just put a question and it rolled down. This would reduce industrial espionage, CO2 emissions through transport, and we could regulate working rights through common jurisdictional systems. I rephrase it a little bit in terms of, do you think, when it comes to our Eastern partners in Europe, something of, a Europe of concentric circles, i.e. different levels of access to the European market makes sense in finance in order to, bind them closer to us, as Orun has asked. And, maybe any experience you have from investing in emerging markets, given your firm.
Yeah, very good question, because it is a question which relates also to some empirical experiences which we have made in Europe in a very substantial way, and that happened in the 90s, right, when the markets opened and Eastern Europe became part of Europe. Turkey got closer to Europe, and capital allocation just changed from overnight, so to say. Why? Because production costs in Eastern Europe just were 10-20% of the ones in the western part of Europe these days, and therefore a lot of, let's say, capital inflow took place. It is interesting that, of course, not only because of the condition changes which took place, or in other words, the cost base of the Eastern European countries increased, the competitiveness decreased over the last decades. Therefore, this, so to say, differentiation criteria was decreasing up to a certain extent, which led to a different equilibrium between the eastern and western part. But also other topics definitely influenced the inflow of, or the capital allocations into these so-called more emerging markets. And we are talking about the legal frameworks. We are talking about political stability. We are talking about currency development, and all these very important topics which are influencing the investment climate. And therefore, it is definitely a strong, let's say, objective for everybody to make sure that these markets are getting closer, that the capital flow is being supported. But of course, these capital flows are the result of market mechanisms. I just can say, from our point of view, we have been in Russia 13 years. We started there on behalf of the G7 countries, and we went together with the European Bank of Reconstruction and Development to Russia in order to help Russian companies to transform themselves to become more competitive. And that was a 13 years old exercise, an exercise which lasted more than 13 years. But then we had to leave Russia because of the changed environment and the ecosystem, which meant that the climate was just not handleable anymore. We have made investments in Turkey, as every international, let's say, as most companies which are internationally driven and oriented. But we lost a lot of money because of volatility of the currency, which also fluctuated overnight, so to say, and destroyed the investment cases. Or in other words, yes, it would be, I think, a very strong support, and I think it is very worthwhile to work on these objectives. But the reality makes life sometimes more difficult than it appears to be.
Thank you very much.
May I just add one thing? I think at the end of the day, we have to decide as well. And, there was always the notion that, Europe or the EU is more than just a common market or but it's as well a value unity, and that is at least on the political side still upheld. And to the contrary, rather seeing to integrate, further emerging markets like the Turkey or whatever, which economically would make a lot of sense. If we look at the peripheral states, like for example Poland or Hungary or so, there is already a pretty challenging question coming up. To which extent they are really all adhering to this value community with regard to division of powers and legal systems and this and that. And that's why I think it's very hard to kind of try to resolve that only from an economical perspective.
Perfect. And I stay with you, Alex, actually. There's a question from Mark Schomburg from Frankfurt. How do you think VC, so venture capital, is going to develop in the next decade in comparison to private equity? Do you see significant differences there?
Well, this is again a question that you have to look at from a geographical perspective or global perspective. I think there is already a pretty attractive and growing VC community on the US side, which is very much a function of the liquid secondary markets that you have in the US. You don't have those to the same extent in Europe, and even if they, even primary seed capital or Series A capital or as well Series B capital can only prosper if you have, as well additional liquid secondary markets, because otherwise you will never kind of find liquidity for your investment strategy, which is a precondition in order to build a ecosystem for venture capital. So as much as I applaud the governments for kind of saying now we have to do something to help and fund VC companies, and then there is an additional whatever 150 million or 200 million or 500 million pocket made available of government help. That is not resolving the issue that there are no liquid secondary markets in Europe. Hence, I think venture capital will be driven as much as many other capital markets product for the foreseeable future by the developments and by the capital that is collected, administered, managed out of the US.
Thank you very much, Alex. Ludo, I'm going to ask you a question, the last from here, the panel, and then what I will do, because we are pretty much close to the end, I will then ask each of you maybe, a final thought on really whatever you want on either the discussion or the future of finance, or just advice to the 150 students which we currently have listening to us, which I very much guess, given that they are on this panel, are interested in some way or form in joining finance. So the question for you, Ludo, is from Agata Pontiki. She's an UTA UCB alumnus in London. Comment on MMT, basically. Does it also imply QE is here to stay? Will sovereign borrowing, become the norm? And how can we ensure that capital allocation to ESG of such large sovereign borrowing actually is effective? But the big, large question from her. But maybe your thoughts a bit on MMT and is this here to stay?
Do we have 3 hours? It's a complex question. First, I don't think we are in an MMT world yet, because if you look at the MMT theory by Bill Mitchell, it would require that we really let the world inflate and then we absorb excess inflation with taxation. I don't see inflation yet. The Eurozone core CPI went up 1.4% today. So I'm sure that we're going to get all the uncertainties of this world saying that we are, at the big inflation turning point. I don't believe that we are. There is a bit of reflation, but I don't believe we are letting the economies inflate just yet, right? Because we don't have velocity of money. So a lot of money injected, but not a lot of money circulating. So debt monetization somehow is stuck in the financial markets. Second, we don't really have a wage setting, price setting group, at least in Europe. And third, I still think we import somehow deflation structure, even though in the short term, I think the Chinese are reflating the world one shipping container at a time when I look at, transportation cost and producer prices. So MMTs, we are not there yet, but there is a big question, which is this Faustian pact between monetary and fiscal, which was sealed some would say even in the late 80s in the US. Or the dot-com bubble, some would say, 10 years ago when we had the big financial crisis. But clearly what we've seen over the past year is that, we had a massive stimulus of 20%, 10 of GDP, 10% fiscal, 10% monetary. And there is a joyous wedding, with many externalities, negative ones, especially distributional inequalities and externalities that are created by this situation. What I think is important looking forward is, all eyes are going to be on what the Fed and the US decide to do. Because as I said, the 2 trillion plan by Biden plus the ECB that has a lot of dry powder, it looks like they're not going to get out of this, Faustian pact and wanted wedding, wedding out of wedlock, sex out of wedlock, you call it whatever you want. And so this is creating a very different market environment. Of course, risk-taking is encouraged. Of course, savings products are less attractive, especially because the bond market is so depressed. But I, for whatever reason, think that the US will get out of this situation. It's a bit different for Europe, because Europe, to get out of this situation, it will take a lot more than what we've done today. And we don't have the same, initial conditions, I would say, like the US. So today, for example, we expect the US to start unwinding the balance sheets by the second half of 2022, and the first rate hike by the second half of 2023. We could be surprised. Let's see if there is an inflection point because inflation is picking up. Biden promised to double the minimum wage. We will see. But I think there will be an exit. And to a certain extent, the big question is the debt overhang, especially on the private sector, because in the US, corporate debt just exploded, especially.
I'm really sorry. I will have to stop you out here. I clearly
no problem.
I asked the biggest question.
It's a complex issue.
I know, which was my mistake. I'm just to give final word as well to Andreas and Alex, because then we are closing on the dot at 11:30. Andreas, maybe final word from your side?
Yes, I would like to emphasize that ESG and impact investments are a great opportunity for students and the future leaders. That is an opportunity that makes the society growing, so to say, together, because it's a topic for governments, society, and businesses. And we, as a private equity firm, as an industry, have a strong obligation to support this development. And it is a common ground which makes the transformation possible. And it would it's a big let's say advice to keep that to take that very serious, to constantly think how that can be translated into business ideas, or change, how can that be translated into changing business models. And therefore I'm happy to be able to deliver this message to the large audience. Thank you.
Thank you, Andreas. Alex, last thought?
Yeah, I want to be very short and brief and a bit going off piste. I've never been privileged to be at such a high esteemed institution like the LSE. I was only studying medicine. So basically what advice I can give is only after more than 30 years in the sort of financial industry. Money and finances makes the world go round. So you are very well established. There is going to be many changes. I've seen long-term capital management crisis in Russia. I've seen the financial crisis. We see the pandemic. Everything will be resolved. And I think you're well placed in kind of keeping your eyes on finance. And from that perspective, you're probably better equipped than many other people to deal with the challenges of the future.
Perfect. Thank you very much. Ludo, last word, keep it short.
Enjoy the ride.
I think
that was short.
What did you say?
No.
I think you froze. Okay.
Sorry, I was very short. I said enjoy the ride.
Awesome. I like that. Okay, I think our illustrious panels, Ludo, Andreas, Alex, thank you so much for participating. LSE, again, thank you very much for organizing this, and good luck to all of you guys out there. Thank you very much.
Thank you very much.
Bye. Thank you so much.